Hello, chart watchers, and welcome to this Wednesday, May 8th, 2019 Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time, welcome to the show, and for our regulars, welcome back. Well, after a couple of days of selling, the market trying to get its feet up under it, you got the Dow Jones Industrial Average currently up 53 points, the S&P 500 up 4.5, the NASDAQ up almost 10, the Russell 2000, though, up only a fraction of a point. 10-year Treasury yield was down earlier today, went down 2.43, has rebounded to 2.46%. Volatility, you can see, really has picked up the last 2 days, was high again this morning with some early selling, has settled down a bit, though, down just under 2%. Today, we've got, looking at the sectors, there were 6 of them here that were all up about the same percentage. Real estate, discretionary, industrials, financials, healthcare, and technology. Notice several of the aggressive groups. Discretionary, technology, financials, industrials bouncing back. That's a good sign, or at least a good start, but we do need some follow through later today, so we'll be waiting and watching for that. But it is hump day, Erin, and we're into the second week now of May. How are you doing today?
I am doing quite well. A little cloudy and overcast, but the market's looking a little bit more perky.
Yeah, I'll pull up some charts in just a moment, but I'm anxious to see. This was really the first time that we've had, in my opinion, a short-term breakdown in the market. Every time we've pulled back in the past couple of months and then rallied off that initial low, we never went back down below that initial low. This time was different. We went down to about 2,900 on the S&P. We bounced, went back down to that 2,900, and it didn't hold this time. So, and I saw earlier we got up to about that 2,895, 2,900 area, and then we came back down. So just got some tests going on here. And so I think in the short term, I'm just kind of cautious. I want to see if we can get back through 2,900.
Oh, yes. Caution. I definitely agree with that. Yep. The VIX is just crazy right now. We haven't seen these kind of readings for a while.
Yeah, and yesterday we did close. I mean, I looked at the VIX and over the past several months, really last year, with the exception of the big move down in Q4, every time we got up to about 18 or so on the VIX, we would drop back down, and that would mark a bottom in the S&P 500 when the VIX hit 18. This time, we went up through that 18 level, so I think you got to be a little bit more cautious as we move forward here.
Absolutely.
All right, we do have a special guest with us today, Brian Livingston. Brian, welcome back to Market Watchers Live.
Nice to be here.
How you been?
Oh, I've been busy. I have been writing 2 columns a week for StockCharts.com. I write my own newsletter, and I write other places, so they never give me any rest.
Well, it is certainly a pleasure to have you back here today. I know our audience is thrilled to hear what you have to say about the market going forward. Do you have any thoughts about the last couple of days? I mean, does that bother you, or are you more longer-term oriented?
Well, I believe that a lot of our listeners out there are long-term investors. They can handle the market going down 1%. If that scares anybody out, they should be 100% in bonds. And the market will go down 1, 2, 3%. The S&P 500 goes down more than 40% once every 18 years on average. That's why we're talking today about how to make more gains in the market with less risk.
Well, that certainly makes sense. I mean, I agree with you. I do think sometimes we overreact. We see the market going up almost every day for 4 months, and then we get a couple of really bad days, and it's, we think the sky is falling, when really you need to step back and put things in perspective. Not bad losing a couple percent after being where we were, for 4 or 5 months. But I know you've got a great presentation. If you can stick around for about 15 minutes, we will bring you back in. Does that sound good?
Yes, I will here.
All right. Sounds good. Let's go ahead and get going with the show, Erin.
Absolutely. Upcoming schedule. Mark your calendar. Tomorrow, John Murphy is going to be with us. Cannot wait. I know Tom and I are very excited about it. Definitely tune in live tomorrow. Next week on Tuesday, I'll be doing a workshop. Not sure exactly what I'm going to do it on, but we'll see. And then Christopher Brecher, he is a new guest on our show. Really interested in hearing what he has to say. He was going to talk about IPOs the last time I talked to him, so that should be interesting. As for today, we're going to start off, of course, with the news and headlines, but then Brian's going to come back and let us know about making more profits with less risk. Our first symbol in the 10 and 10 is going to be DocuSign, DOCU. And then Tom and I will finish out the program with a scooter report. So let's go ahead and get it started, Tom. Technical news and headlines.
All right, sounds good. There really was nothing in the way of economic reports for the third straight day. We really didn't have anything critical out there. So I'm going to start off just taking a quick look at the 10-year Treasury yield, and then we'll get into some of the earnings reports. First, you can see the 10-year Treasury yield I mentioned earlier got down to 2.43%, which when you look back, that's about a 5 to 6 week low. We're not far from 2.35, which was low in March. I think bond market continues to send a message to the Fed. Don't know if they're listening, but Mr. Powell, you might want to check into the bond market. As far as the earnings go, starting to slow down a little bit in terms of the big names. So I think that's important. But we did still last night have Electronic Arts out. Sprint, Lyft gave their first report, their first quarterly report as a public company. And then this morning, a few others came in. We had Honda Motor, Marathon Petroleum, Thomson Reuters, McKesson, Microchip. That was a big one in the semi space. And later today, after the bell, we've got Disney coming up along with Fox and Interactive Corp. And Etsy I threw in there. Etsy's been a really strong earnings stock the past several quarters. Seems like every time they come out, they get a nice gap up. So that'll be one to watch after the bell today as well. All right, as far as some of the stocks, before I get into looking at individual stocks, I do want to just show you the S&P 500 and kind of what's been going on here. Earlier this week, or last week, I should say, we pulled back to that 2,900 level, tried to bounce, came back down, put in that double bottom, and then bounced up again, once again putting in a lower high, and then broke down below the 2,900. Now, when we look back to some of the other periods where we've seen a little bit of selling, negative divergence there, a little selling, when we did pull back again, we never went below that prior low. If you look back at a little bit more concerted selling in March, around the 24th, 25th, you can see off of a high, negative divergence, lower PPO, higher price. This time we had a much steeper sell-off coming down to about the 2780 area, bounced, went back down, double bottom, and then took off again, just like this. We came down, bounced, double bottom, except this time we didn't take off. We failed in actually going a little bit lower. If we go back, though, to the early March low, I think you can see a little different story here with the S&P 500. We had a similar double bottom, almost a triple bottom. We broke down, but we needed to get back through that 20-hour moving average before things started to take off again. So I think that's where we are right now. You can see 2,900 broke as our support, went back up earlier today, hit 2898 roughly, which was right at about where that 20-hour is. It's sitting at 2,900, and we're starting to roll back over again. I think this is a pretty bad signal in the near term, for me anyway. Very little movement to the upside in the PPO. We missed getting through that 20-hour EMA. Now we're starting to roll back over again. What we don't want to see is another new low later today. I think that could generate some additional selling interest and could trigger a bit more move to the downside. The NASDAQ, take a look at what's going on with the NASDAQ. If you look at the NASDAQ at the end of February, early March, see that clear double bottom? We broke below, very similar to what I just talked about on the S&P 500. We needed to get back through that 20-hour EMA. And you can see this also, double bottom at about 79.80. We got up above it intraday, got this to about 8,000, a little above. Couldn't get through the 20-day. Now we're starting to roll over again. Right now, this has just given me a signal of being really cautious, especially with the volatility index where it is. So if we pull up the VIX, you can see here, see how we get up to 18. I'm going to go back a little bit further. Let's go a year. I want you to take a look at these tops. See right back here in May of last year, got through 18 intraday, couldn't close above 18. Same thing late June, got to about 17 in August. And then, of course, the fourth quarter, we easily went above 18. But if you look in 2019, look at the highs in March, right up to 18, couldn't get through. Well, now we've gotten through. I think anytime the volatility is on the move to the upside, I think we have to be really careful. And I'll be honest, one thing that I didn't focus on recently, I probably should have been focusing on more, was if we look at the S&P 500, I'm going to bring it up on this chart just so that we can see it on the same chart. But one thing that probably should have focused on a little bit more and didn't is that volatility was beginning to rise over the past few weeks while the S&P 500 was also rising. I did a chart a while ago showing correlation, and anytime you start, because normally what you have is a negative or an inverse correlation between the VIX and the S&P 500, but when they start to move together for a period of time, that can be a warning sign. And I didn't catch it, wasn't paying attention to it, but that was a little bit of a warning as the market kept going up, seeing that rising volatility. Anyhow, let's go into some of the earnings charts. Here is Electronic Arts. Now, Electronic Arts came out with their earnings. They beat on the top line. They beat on the bottom line by a pretty good margin, but they guided Q1 revenues and earnings per share lower, but they guided fiscal year 20 earnings per share higher. So a lot of mixed signals in this Electronic Arts report. Did gap up. We've pulled back. I'd like to see this gap support hold and see Electronic Arts start to turn back to the upside. What we're seeing on a relative basis is Electronic Arts not performing very well versus its peers. So therefore, I'm not liking this reversal after the gap up. Really want to see some strength start to kick in, get back through that February high. Until then, I would probably leave Electronic Arts for someone else. Sprint, they actually came in. They beat on the top line. They missed on their bottom line. And another one that on a relative basis is telling us to stay away. The stock down almost 4% today with its earnings. Got some pretty good support around the 545 to 550 area. But this downtrend bothers me in a market that's been going higher. So I'd be careful there. If we just pull up a regular, I don't need to go back too far with Lyft because we don't have a whole lot of history here. But you can see Lyft is not getting a lift after its earnings. It came in well below expectations on the bottom line, threatening another breakdown below this double bottom. So we want to keep an eye on that. I do want to mention a couple of stocks, though, and the way they reported versus what the charts were maybe telling us heading into the earnings. TWOU. Now, you might look at this and say, well, we moved up into February. Maybe we had a little bull wedge and we were going to blow out to the upside. Well, the chart was telling us something else because TWOU is in the software space. Software has been flying. This stock has been coming down for the last 2.5 months. So we were at a relative low, a 52-week relative low on this stock just a week ago. What happened? Well, they beat top and bottom line, but they guided Q2 revenues and earnings per share lower, and they guided fiscal year 19 revenues lower. The market was telling us. Stock was selling off in an area of the market that's been going higher prior to earnings. Not a good sign. DDD, this is in the computer hardware space. Another one. Look at the stock, how it was trading the last couple of months heading into earnings. Computer hardware kept going up. Here's a stock at its 52-week relative low just a week ago. They missed on their top line, missed on their bottom line. Not, shouldn't be a surprise if you're following these relative charts. But we do have some on the other side. How about AVLR? And this is a software company. I believe they are in the cloud area. But this is a stock that's been going up. Of course, this one in the software space, was doing pretty well, had come off of its low back in December, and throughout this entire rally has actually been going up faster than the software space. So what they do, they came out, their top line beat, bottom line beat, raised guidance for the quarter, for second quarter in terms of revenues, and they also raised their fiscal year 19 guidance. Look at the volume coming in on this huge gap up. Really important if you're heading into earnings. If you like to hold into earnings, I think looking at these relative charts is really important. It's not going to give you a perfect crystal ball, but it's going to give you a guide as far as to your expectations heading into an earnings report. All right, Erin, why don't you take it away, upgrades and downgrades.
All righty, here we go. 3 upgrades, 3 downgrades are what I'm going to look at. But in actuality, when I looked at the list, we had quite a bit more downgrades than upgrades, but I find the upgrades a little more interesting anyway. Let's go ahead and get started. China Mobile was upgraded today by Credit Suisse from a neutral to an outperform. No target was given. Notice that the PMO has been very flat since the end of April. So we're getting these declining bottoms on price, but the PMO is staying relatively flat. This is mainly due to the fact we're getting pretty much a very steady acceleration downward. So I'm not reading this as positive necessarily. We are getting ready to hit some pretty major support. You could make a case here for that $46 range, which is the closest one. But you could also lower this down a little bit to include those tops back last summer, which would be just a bit lower, about $45.50. It has been upgraded. I'm not so sure about it. I've got a 50 ready to cross below the 200. I mean, it's been in a really serious downtrend for quite a while, but it is getting ready to hit some important support. And if it can bounce off of there, we'll see if Credit Suisse was on track here with that upgrade. Next one up is Mosaic. Mosaic was actually upgraded by 3 different agencies today. JP Morgan moved it from a neutral to an overweight. They changed their target. Wait a minute, I'm looking at it is on the, okay, the targets are being lowered. I didn't notice that. But anyway, JP Morgan, neutral to overweight here with a target of $27. They did lower it from $33, which obviously is pretty far away. I guess they're going to be a little more conservative about this, even though they're rating it an overweight. Credit Suisse moved it from a neutral to an outperform, and they changed their target from $30 down to $28. So they're looking for a breakout above this resistance level at these lows back from December and March. And then finally, Scotiabank upgraded it from a neutral to an outperform. All right. I don't like this stock. I'm not so certain why there was an upgrade. Fundamentally, I have no idea what's really going on with the stock. I haven't studied that because I really pay attention to the technicals. And the technicals here, I wouldn't be sitting out here talking about an upgrade. One of the other things I wanted to show you was the weekly chart for this. Since we did get 3 upgrades, I figured we could go into this one a little bit more deeply. There's that important support that is in that daily chart that we saw. But notice where to me, where the real support is down here at about $19, it looks like. You've got a PMO that had a sell signal at the end of last year going into December, and it is continuing its acceleration down. I don't see any deceleration right now. So to me, maybe you could put it on a watch list. They obviously are seeing something that, or know something that maybe I don't. But technically, I would be waiting on this one. I wouldn't be just going right out there off of that upgrade. All right, moving on. Steel Dynamics was upgraded by UBS from a neutral to a buy. They have changed their price target from $35.50 all the way up here to $47. Looks like that matches up pretty well with that intermediate term support at that September top. Right now, though, it is struggling to get above overhead resistance in the short term. You can see that lines up with that March low, as well as some highs we had back here off of what looked like a flag. I think it's going to be somewhat strong support, but you know what? The PMO is telling me that we should be able to break above it. So I think that technically this looks pretty sound, but for me and the way I invest, I prefer to wait for the breakout here. But the PMO is really looking promising at this point in time. OBV, not so much. Scooter is starting to gain a little bit of strength. All right, moving on to the downgrades. Mizuho downgraded Avalon Bay from a buy to a neutral, and their price target has been moved to 210. So I suspect it must have been a lot higher. I see a double top here. I see a move toward that confirmation line and a top below the PMO. I think this downgrade is warranted. I would certainly be not looking at this as an investment opportunity. See a double top off of a nice run to the upside like that, not good. Walmart actually was downgraded today by Wolf Research from a peer perform to an underperform. I do have that PMO buy signal. This I thought was very interesting. The rising bottoms trend line off of the December low and the April low, we got a breakdown. So while we're holding this support level at the tops we saw back here, we did get a breakdown from that rising trend with that sell signal. So caution on Walmart. And U.S. Steel, finally, UBS upgraded this from a neutral to a sell, and they lowered their target from $22 all the way down to $10. So they aren't feeling too good about this. I have to say there's some possibilities here as far as it holding that support level, mainly because I was noticing that we are getting a breakout there on the PMO, but I don't think I would be at this point gambling on that. And if we look at the weekly chart to get a better idea of where support is to the downside, 1250 I see right here, and of course all the way down here would be that 2016 low, which is certainly in play. But $15 level, I think we're going to have to go a little bit further down. So I agree with this downgrade on the technical side. All right, that's all I have for upgrades, downgrades. There's our summary slide. And since I took a little extra time here, I'm going to ask you to go look at the Market Watchers recap later, and you can look at some of those upgrades that I didn't go over. All right, Brian, time to bring you back in. Very excited to hear about how to get some profits without less risk. That's always a great subject.
Very nice to be here.
Mm-hmm.
Shall I go ahead?
Yes, please. We're waiting with bated breath.
All right. Well, I'm Brian Livingston. I write a column for StockCharts.com twice a week, and I write columns other places on my own monthly newsletter. Today, I know that we all have questions and concerns. The market is getting more volatile. It looks like the market is swinging up and down. It's dropped 1% or more about a handful of times in the past few months alone. So,
hey, Brian, I'm sorry. Sorry to interrupt you. I just wanted to make sure that you grab the screen and share your screen.
Okay, let's do that. Are you not seeing my screen?
Not yet.
Not yet. No.
What? We're getting some help here.
Yes, yes. Don't worry, it happens to us all the time too.
Zach is in the background making this all happen.
He makes
I
it
will.
all.
Yeah, I will be taking questions for Brian in the chat room. So if there's something you wanted to ask him, go ahead and type it in.
Very good. Can you see the little boy here on the screen?
Yes, I love that picture.
This relates to my latest column for Stock Charts, which is titled, "To Make More Profit in the Market, It Helps If You're Brain Damaged." That is based on some findings that people who have a damaged or non-functional part of their brain that controls their emotions, that controls their fear, if they have a lesion or some kind of a tumor that interferes with that section of the brain working, they actually perform better on simple investment games than normal people who have no brain damage at all. That's very unusual. You can see in this particular game that the researchers played with these brain damaged people and with normal people, that the people who had no experience of fear made about 28% in an investment game, and people who had normal brains made about 14%. So the people without this area of their brain that controls fear had double the gain of the normal people, and we can learn from that. We can take advantage of that in our own investing. The way that the game was structured is that the researchers met with the people in the study one at a time and gave everyone 20 $1 bills. So you have $20. There will be 20 rounds of coin flipping. Each time you get the choice of invest $1 or hold back and not invest $1. If the coin came up tails, you would win $2.50. But if the coin came up heads, you would lose your $1, lose your total investment. So after 20 rounds of this, what was the difference? Why did the people who had some brain damage make twice as much gain as the people who had normal brains? It's because when the coin flip went against them and they lost their investment, the people who were brain damaged bid again the next time. They chose to invest in about 86% of the time. The people who had no brain damage experienced fear of loss, and they chose to invest in the next round only 40% of the time. That's a big difference. That is the way a lot of us investors experience the market, is it just went down 1%, so now I'm going to pull out. Well, that's too short term. That's very much reacting to noise. So what we can learn from this, my entire article is at this short URL, bri.li/190507. That's a lot easier to type in than the whole URL at StockCharts.com. So I encourage you to write this down. Don't go there now until the show is over. But this gives you all the information about this, and I plan to follow this up with some additional columns. Erin, any questions?
Not yet.
Let's go on to something else. Our beliefs and our behavioral biases are big factors in how well we do with our long-term investments and even our short-term investments. What do we hear when the market calls to us? Usually it's a wrong number. We get a lot of signals, we get a lot of noise. When we react to noise, when we react to short-term signals, we often are just making a mistake. So people have been researched by academics. They have been studied by people who got access to all of their trades with all of the personal information taken out. And here is the result. If you look at the investors who got rid of some mutual fund because it had had an underperformance in the last 3 years, and they bought some other mutual fund, what happened in the second 3 years is that the fund they divested themselves of did better than the fund that they bought. So we have this unfortunate tendency to equate the performance of the last 1, 2, or 3 years with the performance in the next 3 years. That, unfortunately, is a fallacy. There is a reversion. The technical term is reversion to the average. Academics call it reversion to the mean. It's the same thing. The market and securities in general have a tendency to have a hot streak for maybe 2 or 3 years, and then they'll have a cold streak for 2 or 3 years. If we try to chase that, we will just be selling securities that will do better in the future and buying securities that will do not as well. So let's look at our 3-year experience. We're in 2019 now, obviously, and in the last 1, 2, 3 years, the market has mostly been up, up, up. Of course, we've had a correction in the fourth quarter of 2018, but now we have had new highs recently, and so it looks like maybe we're okay. Maybe the market isn't going to go down. Maybe it'll just keep going up. You have to wonder if we can't rely on the experience of the last 3 years, what can we rely on? Here's what is the experience of people who are professional money managers, people who are institutions, who hire outside money managers. It's very shocking that 100% of the institutions that manage money using outside managers fire managers who underperform in the past 3 years. Actually, 40% of the active managers get fired after only 1 year of outperformance. If you're talking about managers of smart beta portfolios that are weighted in some way other than the market capitalization of the portfolio, the institutional funds fire outside money managers within 1 year of underperformance 80% of the time. And again, 100% of the outside managers, and this is a study of thousands of major financial institutions that hire outside money managers, 100% of the outside money managers are fired with 3 years or less of underperformance of some benchmark that they may have. When we look at the specific results of the managers who were fired and the managers who were hired, we can see that the investment institutions chose to get rid of outside money managers who had outperformed their benchmark, but not by as much as other outside money managers who did really, really well. On the left side of this graph, we see that the money managers who were fired had beat their benchmark by 2 percentage points. But the outside managers had a really good run of luck and outperformed their benchmark by 11 percentage points. After the firing of the underperforming asset managers who were actually outperforming, but not by much, and the hiring of the outside money managers who'd performed very well, you see on the right side of the chart that the managers who were brought in the next 3 years only beat their benchmark by 3 percentage points, and the managers who were fired went on to a performance of beating the benchmark by 4 percentage points. The institutions would have been better off staying with the people who had had a cold streak because securities revert to the average. Those people and those securities that have a cold streak will often have a hot streak after that. So looking at 2019, we really can't trust what we see from the experience of 2017 and 2018 when we are looking for what the market might do in 2019, 2020, and 2021. It's just a fallacy that we think the recent past is going to be repeated in the future. What's true is that the recent past may just come back to the average. It may just revert to its usual growth. The stock exchange in the United States grows about 6% per year on the average, plus inflation, which brings it up to about 9% a year when you consider inflation. And we can count on that, but we can't count on that every year, and we can't project from the last 3 years what the next 3 years will look like. Researchers did another study which shows how much the investors would have made if they had followed the strategy of the last 3 years and followed it for the next 3 years. This text is very small, but I'll read you the top line. Only the top line is really important here. If you followed the investment strategy that was in the top of performance in the last 3 years, your raw return on the top line here would have been 8%. If you had instead chosen to follow for the next 3 years the investment strategy that had been right in the middle of the past 3 years, you would have made about 9.7%, which is about 1.5 percentage points more. And surprisingly and shockingly, if you had decided to follow for the next 3 years strategies that had been in the very bottom of performance in the previous 3 years, your raw return would have been 10.4%. That's more than 2 percentage points higher than following what strategy was the winner in the last 3 years. So it's really something that is contrary to human nature. It's contrary to our intuition. We think that things that have been happening for the last 2 or 3 years are going to keep happening, and that's not what the market tells us. The market tells us that it is going to revert back to average. Those who are on top will not be on the top in the next 3 years at all. So we need to construct our portfolios by paying attention to the things that are important and leaving out the things that are just noise. We can do that, hopefully, by learning to use a style of investing that works for us, a style of investing that really tries to tune out the noise and tune in the signal of what the market is telling us. One of those systems is in a class of investing strategies that are called mechanical investing. So in this illustration, we see there are dozens of different styles of investing. You have options on futures, you have currency trading, and all of that. But most investors in the United States and elsewhere use one of 3 styles of investing. You can use passive investing, which is just to invest in several different asset classes and hold them for years. You can use active investing, which is doing research, and then acting based on your opinion, what you should get rid of and what you should buy, which, as we've seen, people usually guess wrong. Or we can use mechanical investing. That means following a formula, relying on the formula, letting computers do what they do well, which is crunching the numbers and coming up with a rating system, and following that rating system without imposing our own opinions on top of it. To get all of these illustrations and to get more background on what these studies show, go to this URL, bri.li/190409. That leads to the top of a series of articles that I've done on all of these charts, and more. Any comments?
Nothing yet.
Okay, good. I hope people are finding this interesting, and I hope they're writing down these little short URLs, because wading through the pages at StockCharts.com, which is very, very educational, might be a lot slower than just going right to the top of these articles.
Oh, yeah. Okay. Actually, I'm looking. Let's see. Does reversion to the mean suggest better opportunities can be found by buying on pullbacks?
Well, what we need is a mechanical formula. That's my feeling, just to impose my opinion on it, that we as human beings are programmed by our DNA to guess wrong when confronted with the noise of any stock exchange. There are earnings, there are predictions, there are analyst reports, there's all of this sound and fury that comes out to us about the market. If we can boil it down to what is really important for us, which is how much money am I going to make in my portfolio over the next complete bear bull market cycle? On the average, a bear bull market cycle is about 8 years. In this case, we've had a bull market for 10 years. That's not the longest bull market in history. The market from the 1987 crash to the top of the 1999 through 2000 peak, that was 13 years. So you can have a 13-year bull market. We're not at all able to say that the market will crash this month or next year or at any time. The market crashes due to some shock, some disbelief in the system, some fear that other people are getting out, so I'd better get out. That can't be predicted. But what we do know is that diversifying our portfolios is a great way to gauge how much risk we're going to take and to prevent ourselves from feeling fear and feeling panic when the market does turn down. So a great question for us is, what ingredient can we add to stocks to make our portfolios more diversified, but at the same time make them more profitable while being less risky? That's a question for the ages. Diversification is something that I think is undervalued by a lot of investors. And we're going to look at some cases here. If I have about 5 minutes or more, do I have enough time to go into this?
Oh, yes.
You've got plenty of time, Brian.
Mm-hmm.
Okay, good. So let's look at a case here where we should be able to decide what the best portfolio would be for our needs. This graph shows an imaginary stock exchange. It only has two securities. One is a money market fund, which goes up 0.1% per month, about 1.2% annualized. And the second is a security, which is a boring utility stock or something else that just goes up and down in a trading range from 100 to 85 to 70 to 85 to 100 every month. The question is on the top of the screen. Which asset allocation will give you the highest rate of return? If we know in advance that you've got the money market fund giving you a certain return and you've got this boring utility stock that's stuck in a trading range, if we knew that in advance on this imaginary two-stock exchange, what would we do to allocate our money? A, would you put 100% in a money market fund? B, would you put 100% in security B? C, would you put 50% in A and 50% in B, rebalanced monthly? Or D, it can't be determined what the best portfolio would be given these various criteria. We see at the bottom in the assumptions that it costs us 0.1% for each round trip transaction we make to rebalance our portfolio. So just think, what would you say is going to produce the highest rate of return? A, B, or C, or it can't be determined from the information we have available. I'm going to go to the next slide and show you the answer. The answer is C. Putting half of your money into the money market fund and half of your money into the range-bound security and rebalancing once a month with a fairly low round-trip transaction cost, as we have today with exchange-traded funds, produces a much higher rate of return than either of the securities individually. Many people think, looking at the previous slide, let's go back to it, that the money fund has a higher annualized rate of return, so the best you can do is put your money in cash. That's not the case. By using diversification in this very simple artificial example, we see that we can make more money out of a two-asset portfolio by rebalancing, and that is because when the security has gone down in price, it's gone from 100 to 85, or it's gone from 85 to 70, you're taking some money out of cash and you're putting it into the security. When the security has gone up, you are taking some money out of the security and putting it in the safety of cash. Over time, that produces a great return for you, but diversification takes time. If you look at this point that is marked by the circle on the screen, it actually took you more than 3 years before your diversified portfolio was consistently ahead of an investment in security B, which was flat. If you look up here, about 4 years into this 8-year period, it took 4 years before your diversified portfolio was consistently always at a higher balance than just putting your money in the safety of cash. Now, of course, after 8 years, we see that the diversified strategy was making 5% annualized, whereas the money market fund was only making 1.2% annualized. This is the magic of diversification, that by keeping your money diversified and by rebalancing it as needed, that you are able to eke a profit out of the market in a way that is not possible by putting 100% of your money into any asset. Now, as I've said, this is an artificial example. Let's look at one that has random behavior in it, not perfectly predictable behavior. In this example, we have two securities, and they're both stocks. They're both volatile stocks. Security C is the purple line on the top here in this graph. It has an expected return of negative 11% per year. Security D is a little worse. It has an expected return of negative 12.8% per year, but they're volatile. They go up and down 15, 20%, 30%, 40% based on random chance of a coin toss. So you can see that over this 4-year period, both Security C and Security D had a loss. They had pretty big losses. They were down about $40 or $42 after this 4-year period because of their volatility, because of their tendency to go down when the coin flips the wrong way. You can see that the Security C did really well. It had a hot streak there in the first 2 years, and then the volatility caught up with it and it fell below its original value. The question at the top of the screen is, should you put 100% in Security C? Should you put 100% in Security D? Should you put 50% in C and 50% in D, rebalanced monthly? Or it cannot be determined given the information available. So we know how volatile these stocks are. We know what their expected return is. We don't know their future path. All we know is that they're volatile and they have expected returns which are not very good. So what would we choose as the portfolio that would be the most profitable in the next 4 years given this information? The answer is C. If you put 50% into Security C and 50% into Security D, and you rebalance your portfolio once a month with the 10 basis points transaction costs that we show on the screen, you actually produce a higher return than either security individually. Now, with random chance, anything could happen. When you're flipping a coin, Security C could have gone up, up, up every month for 48 months. That's usually not what happens. When a security has volatility and a security has poor prospects or a poor expected return, the truth is that you can still extract profit out of securities like that with diversification and with rebalancing. This is not something that we are showing any actual stocks here. This is another imaginary scenario, but this scenario uses actual volatility. It uses actual expected returns that are like a lot of companies that are in the market. They aren't the big companies that shoot the lights out. They're the companies that kind of put along. They're not doing very well. They're kind of gradually declining in value. But with the right strategy, you can actually extract gains out of securities that both have a loss over a 4-year period. Now let's look at our final example using some securities that actually exist that you actually could have purchased. Here we have in the orange line the actual return of the S&P 500 based on index funds like Vanguard VOO. The blue line is an index of US bonds, which is similar to index funds like Vanguard's VCLT, long-term bond fund. And here in this case, we're going to ask you the question, which asset allocation will produce the highest rate of return using the actual historical performances of these two index funds. Would you put 100% in the S&P 500? Or B, would you put 100% in bonds? Or C, would you put 50% into the S&P 500 and 50% into bonds rebalanced monthly? Or D, you cannot determine the answer given the information provided. Think of what your answer would be. 50-50, 100%, 100%, or it cannot be determined. The answer is A. In this case, strictly having a 50-50 portfolio did not wind up with the highest return. Unlike the previous examples, the 50-50 portfolio made 9.8% annualized, as we see in the upper right corner here. The S&P 500 made 10% annualized, and the bond portfolio alone made 8.9% annualized, as we see down here. Now, it's not that the 50-50 portfolio will always underperform. Actually, if you look at the purple line from the bottom to the top, the portfolio that is a 50-50 stock bond portfolio, which my book calls the baby bear portfolio because it's so simple, it's just a 50-50 balance of stocks and bonds, that outperformed the balance in the S&P 500 account in 67% of the months. In about 2/3 of the months, you would have had more money in your purple portfolio that was 50-50 stocks and bonds than you had in the S&P 500 because it's highly volatile, has crashes, has bear markets, and that sort of thing. So as we have seen, there are benefits to diversification, but how can we get the maximum benefits out of diversification? How can we pull a rabbit out of a hat and make ourselves sort of insulated against the worst market crashes? That 50-50 stock bond portfolio only went down about 29% in the global financial crisis, whereas the S&P 500, including dividends and adjusted for inflation, went down more than 50% in the global financial crisis. How can we do a little magic trick here and keep our losses smaller so we can stay with the market all the time, but we are not suffering big losses that are going to be hard for us to recover from for years? One thing to do is to broaden our portfolio universe. We can see that at the top of the screen up here, the S&P 500 is 100% correlated with itself, and small caps, developed market stocks, emerging market stocks, and REITs are highly correlated with the S&P 500. When the index goes down, these other asset classes are very likely to go down. Bonds, like the investment grade corporate bonds and the treasury bonds, are negatively correlated with the S&P 500. When the market goes down, these fixed income assets are very likely to go up. Now, the interesting assets are called alternatives. They're in the middle here. Commodities, with only a 44% correlation with the S&P 500, is really not that correlated with the index at all. That makes commodities very independent of the performance of the S&P 500. Even more independent is a subset of commodities called precious metals. So looking at gold index funds, they only have a 4% correlation with the S&P 500, which is effectively zero. What the stock market does doesn't have any relationship with what gold does. They act completely independently. So when the stock market is going down, it may be that your gold and your precious metals, as well as your commodities, are going up. So we'll look at how that dealt with the actual global financial crisis right here. This graph indicates the global financial crisis from October 9, 2007 to March 9, 2009, about an 18-month period, which was the most severe recession that the United States and much of the world have had since the Great Depression in the 1930s. You can see by the orange line that the S&P 500, adjusted for dividends and inflation, had a 56% loss measured between daily closes. Other asset classes like real estate and small caps and so forth had losses of 60 to 70% in that same period of time, as you'll see at the bottom of the chart here. But look at the other asset classes that we could have had in our portfolio. Treasuries went up 18% during the global financial crisis. Gold and other precious metals went up during the global financial crisis. A gold index fund was up 22% in that 18-month period. Commodities, which are primarily agricultural products and energy, were up an amazing 66% during the first half of the global financial crisis, from October 2007 to July 2008. Now, you need to have a mechanical formula to decide what your portfolio should have in it. You want to tilt your portfolio towards those asset classes that are in uptrends and tilt your portfolio out of those asset classes that are in downtrends. How do you determine that? With a mechanical formula. The reason is that you wouldn't want to be in commodities for this entire 1.5 year period. At some point, people around the world realized that there was a huge recession that was upon us, and there was going to be less demand for industrial products, for agricultural products, for base metals, and so on. And so the commodities index actually wound up 20%, 28% lower at the end of the global financial crisis than it started. So if you had a mechanical formula that could tilt your portfolio toward commodities when they were in an uptrend, and as soon as it lost its momentum and went into a downtrend, you would keep your assets away from commodities. That is how you can make money even in a bear market if you know the formula. Now, all of this and all of these charts are in my book, Muscular Portfolios, and they're in articles on StockCharts.com, which start at this URL, bri.li/190319. So write that down. I think people can learn a lot about not putting all of their eggs into one basket, having diversification, having a set of asset classes out of maybe a dozen. You want to invest in at least 3, and you want to invest in 3 that are in uptrends as opposed to in downtrends. That is not a secret. The formulas have been published by many academic researchers in white papers that are on the internet. But who has time to read all of these white papers? Well, I did. I read over 1,000 papers and strategies that have been proposed, and the ones that have the most veracity, the ones that have the most predictability are in the book, and they're in my columns in StockCharts.com. They don't work in a year. You won't beat the S&P 500 every year. The point is to beat the S&P 500 during our lifetimes. And you do that by beating the S&P 500 over every bear bull market cycle. That means if you're going to live another 8 years, you're probably going to experience a bull market and a bear market within that space of time. And we'd better get good at it, because with the market at all-time highs, it is just as likely to go way, way down as it is likely to go way, way up. And we need to be cognizant of that fact. I'm going to go into some other stuff about probability, but I don't mean to keep us over time if we're going to take a break or anything.
Yeah, we're going to have to close this off, unfortunately, but I did have one other question that came in, and it is about what you had talked about earlier. And it says that, you were discussing managed funds and, money managers, and, they wondered how the higher fire idea works, with ETFs, which are, different from that managed fund. Is this, they're asking, is your message to buy the worst performer? Which I don't think it really is.
That's a very good question. What we know about ETFs, they work like mutual funds. They work like individual stocks to some extent. And our human minds are of the programming that leads us to reject what has underperformed in the last 3 years and to outperform. Those ones that we rejected from the last 3 years' performance are likely to outperform the funds that we choose to buy instead. That's just the way the human mind works. Now, I did show you this graph, which showed that the strategy of following investment strategies that had done the worst in the last 3 years produced the highest return in the next 3 years. I am not recommending that. I recommend that you read the article that was in my tiny URL and see what it is that the researchers actually found. I think it's too stressful for individual investors to be so contrary that they put their money into something that did the worst in the last 3 years. That would be something that you would have to have nerves of steel. You would have to have cold water running in your veins instead of blood to do that and be a human being. It just rubs us the wrong way. It goes against our grain. What we should do is the asset classes that are going to do well in the next 30 days are those that have done well in the last 3 months to 12 months. This is a very strong tendency. It's called momentum or relative strength. And so my columns and my book, Muscular Portfolios, show how to use that, because what you're doing is you're buying high and you're selling higher. I think that's a much easier policy for individual investors to follow because, look, this thing has gone up in the last 5 months. Look, this thing has gone up in the last 12 months. You're buying into strength. So a purely contrarian strategy is very easy for academics to say, oh, look, if we did what performed worst in the last 3 years, we would do the best. Well, yeah, and if I drove my car backwards, I might be able to go faster down the freeway, but that would be a risky and a scary maneuver for me to do. Let's do something that's easy for individual investors to do. Let's do something that has them buying into strength. Read the report, and if you choose to invest in the things that did the worst in the last 3 years, fine. But these are academic studies. They are not real people with real money who had to live with their real emotions.
Exactly. That does make a little bit of a difference, I would say. Well, it does look like we are ready for our 10 and 10, but I just wanted to thank you for coming by and giving us that presentation. I know a lot of people were interested because when I get fewer requests for the 10 and 10, I know that people are watching. So, and this is the info to get a hold of you?
Yes, I recommend that people type in bri.li/MP. This is a cloud server that I own, and I use bri.li to make short URLs for people so they can just type in a short web address and go right there. That takes you precisely to muscularportfolios.com. If you prefer to type in that long URL, be my guest. And there you will find the free newsletter that you can get. You'll find the book, which is at Amazon and Barnes & Noble and every other bookstore in the country. And a lot of free information that I've put out that shows people exactly how mechanical investing works, exactly what they can buy and sell right now. It's the first website that gives away the signals for free of what Wall Street knows you can buy and sell without you paying 1%, 2%, 3%, or more of your life savings every year to some advisor who isn't going to do any better for you than you can do for yourself.
Yeah, it is your own money, after all.
After all.
All right. Well, thanks again for coming in. Tom, I'm going to bring you back in. It is time for that 10 and 10.
Yep, I do. I also want to thank Brian for stopping by. Really appreciate it. Great presentation today. And I don't know if you, we do need to move on, but I don't know if you do anything with currencies, Brian. But I know currencies can impact the price of some of those ETFs, especially foreign ETFs. And just wondering, maybe, I don't know if this could be a future topic for you to come on and talk about, but I was just curious as to the dollar and how that might impact some of your diversification strategies.
Yes, currencies are very interesting. Studies show that more than 70% of currency traders lose money. This is in a chapter of my book, Muscular Portfolios. We don't want to go into it today, but because you're betting that one currency is going to go down and another currency is going to go up, if you just made trades at random, you would have a 50% chance of being right. Unfortunately, our brains make us wrong in 70% of the cases. Currency traders go broke within a year or not even that much because they're guessing about behaviors that act in ways that our human brain simply interpret wrongly. So I know that there is money to be made in currency trading, and I don't know if a lot of individual investors have the stamina to be able to do it.
Yeah, I know you had talked about commodities, and of course, some of these ETFs, especially foreign ETFs, currencies do have quite a role in some of that. So I think maybe that would be a good topic, though, for a future future presentation of yours, if maybe you give that some thought.
Sure.
Okay. Well, it was great having you on here again, and we look forward to having you back again soon.
Thanks.
All right. Thanks, Brian. Okay, Erin, do you have an RRG ready to go for the 10 and 10?
I actually do. So I will pull that up right now. And we did get about 20 requests. And when I look at it as far as sector, I think people want to look at some technology stocks today, Tom.
Makes sense.
Over half, I think, are technology stocks. So anyway, let's go ahead and get started. NVIDIA, I think, is going to end up being our most popular, but go in there and vote, everybody. I do think it has an interesting looking RRG.
All right, I will start with our first one, which is DocuSign. And here it is. I actually think it's just consolidating. I like the pattern here. Beautiful move up. Now, some might look at that and say, well, volume trends have turned negative. I don't really look at it that way. I see higher prices here. I see the PPO going lower. I think the stock needed a pullback. We had a false breakout there and a complete reversal closing near the low. I think that got the sellers a little bit more interested in the near term. We went down, established a key low, bounced off of that, and now I think we're in our trading range. I think we've got 59 to the upside, about 52 to the downside. I really like this candle here. This is what I look for a lot of times in a stock for a false breakdown. If you like a stock in an uptrend and it goes down, sets it a low, bounces, and then goes back down below that low intraday, comes back up, a lot of times that's a kick save, and you can see the next 4 or 5 days pretty strong. Now, after getting up near the top, we've kind of made our way back down toward the bottom. So I like entry on this stock as it gets closer to 52, and I like selling around 58, 59.
All right, perfect. Let's see. We have a 4-way tie for most popular, but let's go ahead and we'll start with Tandem Diabetes. That one we have looked at in the last week, but everybody wants to see it again.
Yeah, the healthcare stocks are starting to come back into favor a little bit, and that's helping the stock. It was actually an outperformer for quite a while, went through a rough patch end of March into early April, but essentially really just filled a gap, which was kind of a big move here, big reversal. There was the gap. Didn't quite get all the way down there, but it did go back and test the prior breakout. So you can see that gap up took out that prior high. The move back down, I would have said longer term, this is a really critical area here, about 49.5 to 52. It held. It's going back up. Look at the range, though, on this stock. We're talking about 50 to the downside, 75 to the upside. So there's a tremendous amount of volatility here. If you don't like volatility, it's probably not going to be a stock for you. You can see it was after earnings, it was 67.5, went down to 57 the same day, came back just 2-3 days later. We're right back to 67. Now currently 65 and change. So I just think you have to be willing to take on this volatility. But overall, I like the chart. Again, if healthcare continues to perform well, I fully expect we're going to get another test to that 75 level.
All right. Let's see here. One of the other ones that was tied was Roku.
They report after the bell, I believe, today. So you do want to keep that in mind. But yeah, I mean, after the big move up in February, I believe that was earnings related right there. You can see that we went down and tested the low that day. So this is where all the volume came in on the buy side. See all this volume? So we gap up. And I always talk about when you get a gap up and you get the hollow candle, don't necessarily look for that gap support on the bottom. A lot of times you don't get it. I think this was a perfect example. So I'm going to get rid of that. I still believe that the level to watch here is around 55, maybe 55.5. The top side, I'd be looking for resistance up near 75, very similar to TNDM, Tandem, in the outlook for volatility. It's an incredibly volatile stock. We're sitting in the middle of the range, but I still like it. Maybe things change with the earnings report. I think the earnings report could go either way in this wide range. We could be down 10 or up 10 after the bell, and I wouldn't be shocked based on this wide trading range.
All righty, let's see the next one up. Also part of the most popular, NVIDIA.
All right, NVIDIA. Well, some of the stocks, I think with the trade war, some of these semiconductor stocks have gotten hit. I do like today's candle so far. If we can hold it into the close, that is a piercing candle off of a downtrend. If it gets back up over about 178, we'd have a bullish engulfing candle, which would be nice as well. But you can see we've come down and tested this area, and this was a key reaction high over here. So I think this is 171, 172 level is pretty big for NVIDIA. So if it fails to hold there, I think you've got other semis that look a lot better. So I would watch the low today pretty closely.
All right, let's see. And the last one that was part of the most popular group is Domo, D-O-M-O.
Yeah, this one had a really nice day a couple days ago, gave it all back. Now it's starting to move back up. But again, it's staying within this range. So as long as the stock, after gapping up, here was the gap up. Here's where the buyers came back in. So it was selling off during the day, Buyers came in, sent this stock from 35 to 45 over 3 days. And now you can see the retest of that low. That's where the buyers came back in again. And so far, we're holding that area. So I would continue to watch this area for support, resistance up near 45, another one with a pretty wide trading range. But I think the closer you are to 35, the better I like it from a reward to risk standpoint.
All righty. Next one up is our only materials stock, KL.
All right, this is Kirkland Lake Gold, and they reported yesterday, I believe. I think that was the heavy volume here. It might have been today, but I know I've just seen it. But I do like the PPO coming back up, trying to make this cross. Hasn't quite gotten there yet, but I do like the fact that we're back up above the 20-day moving average. I would just simply keep a fairly tight stop. I think if we go below these recent lows, then I would be more concerned about the stock. It has, and those are the lows I'm talking about, so just below 31. I think to the upside, we had pretty good support right in here, went below it, struggled to get back up above it. Here we are again. So that's the trading range I would consider. Now, this one's been off its high for 2.5 months. So that's why if it rolls back over with the PPO having already been in negative territory, I'd be a little nervous. But I'd look for a breakout above 34. I think that would be bullish.
All righty. Let's see. Next one up. This one was actually downgraded today. Mylan, MYL.
All right, Mylan, yeah, I think that was earnings related yesterday. Big move to the downside. I think they lowered their guidance, and the stock was already trading pretty weak. But you can see the double bottom that was taken out. That is not a good sign right there. Low here on heavy volume. So the buyers came back in with some pretty decent volume, couldn't sustain it, and then we broke down. Now, this one could go anywhere from here. I mean, this is a big move to the downside. It's oversold. You can see the RSI now down 23. It could make, I don't think it's going to go all the way back up to the 26 level, but that is the overhead price resistance now. Instead, what I suspect is we'll consolidate, and as that 20-day drops, that's probably going to be the area of a major test down the road. But I don't like it here. I think this is a stock that has certainly been underperforming for quite a while, and I want to try and get my portfolio loaded with some outperformers. So I'm going to pass on Mylan.
All righty. From Comm Services, Vonage, VG.
All right, beautiful move today. I don't know. I didn't hear this one reporting earnings, but maybe it did. That's a huge move today to the upside, up 11%. I'm also going to straighten this chart out or lengthen it out a little bit. Let's look at a year just to see how this compares. Yeah, it's a pretty big move to the upside because here was your reaction high. You pulled back, held on to some recent lows around 9, and now broken out. It's starting to look much, much better from a technical perspective. You can see that daily PPO getting big breakout to the upside above the 0 line. So I think what I would do is draw a couple lines in here. Number one, that was a big breakout right here. Notice the gap up was up at 1086. When it pulled back, it hit that price support and then took back off to the upside. So I think 1060 is a level I'd watch pretty closely. I think if you break below that to the downside, I'd be concerned because you do have a stock that was not performing very well. I don't have a relative chart on this one up right now, but you can see this rally here was nowhere near the highs we saw August, September, and October. So you have a relative underperformer, but this is the type of candle that looks like maybe a character change. So I'm growing more bullish on the stock, but I would keep a tight stop if that low today fails to hold.
All right. Let's see. A semiconductor for you that we haven't looked at in a while. KLAC, KLA 10 core.
Yeah, I don't like the negative divergence, the big volume gap below the 50-day moving average. Now, this also came with the trade war kind of heating back up again. So maybe, I'm looking back to see if there's some key area maybe to look for a reversal. And I would just say that perhaps it would be this low over here. We have a couple of lows around the 112.50 area right here. See these two moves down? This one on pretty good volume, this one on decent volume. And then we went up lower PPO, higher price. So the 50-day I would have been expecting anyway. This went a little bit below, and that heavy volume bothers me. I'd want to hold this low because if you don't hold this one, then I think you could be looking down to the next major low and gap support area, which is down closer to 100. Yeah, I was a pretty big fan of KLA 10 core. But after that earnings, I don't like that negative reaction. So for now, I think I'd look elsewhere in the group.
All right, and our last one, I have to say this one's a little tempting to me. All my indicators aren't really there for it, but it's the bottom of a pretty solid trading range, and that would be Deere, DE.
Yeah, Deere's actually been outperforming, I think, Caterpillar. I'm just going to pull Caterpillar up real quick. Yeah, Caterpillar didn't quite get back to those highs. And yeah, see how Deere has broken out to new highs going back from October. And if we go to Caterpillar, see how it's going the other way. So I think on a relative basis, I think you have a better stock, I think, with Deere, and you're also right at support. So I'm not a fan because I think the PPO turning negative, this isn't a stock I'm going to rush out. But if I was looking at Deere and I was looking for a key level to buy, I think that it's clear here that 155 needs to hold. We have multiple tests at 155, including today's low of 155.35. So I think you could play this trading range with a possible, well, from 155 and change, possible 10% move or close to it to the upside with very little downside action. So I like the reward to risk, but I think there are obviously some other areas of the market that have been better than this area.
Yep. That does conclude the 10 and 10. Here are the symbols that Tom just annotated. I will have these exact charts up in the Market Watchers Live chart list. Just go to the Market Watchers Live blog from the Articles blog tab and select that blog, and you will see the link is right there up at the top. All right, time to get started on our final market update. But I did want to mention something that is going on right now that maybe some of you did not know. But currently, StockCharts is running a special for the spring. If you go ahead and sign up for 12 months, you will get an additional 2 months added to your subscription. So recommend you go check that out. You probably have seen the banner coming in above your charts up here. So go take a look. All right, but it is time for that final market update. Let's see what's going on. Get this updated completely for you. All right, markets are higher on the day. It seems a little bit on the tentative side. I think we've been talking about that. Dow Jones is up almost 1/3%. Currently, S&P 500 is at 2891 and rising slightly. NASDAQ continuing in its rising trend since yesterday's low, up a little over 17 points. And that is a 0.22% move. New York Stock Exchange also up currently. Russell 2000 small caps are now down in negative territory, and they have spent more time on the negative side than we have seen on the other major indexes, the larger caps. TSX is on the rise, and we can see that TNX is, well, that was the TSX. The TNX, the treasury yields are higher right now, reading 24.84, and VIX is now falling, but still at a reading of 18.81, which is certainly on the higher side from what we've seen. UUP is up on the day, 2 cents at 26.22. GLD is lower on the day, not surprised when you see the dollar rising, and it is reading 120.89. USO is forming a bit of a flag here on the rise, currently up 1.25%. And TLT bonds are turning over today after a really nice run over the last part of the trading week, and now we are going down and getting ready to test some gap support here as TLT moves down. I found the sector summary to be especially interesting. Currently, you can see discretionary technology are starting to make a little bit of a move to come up here and challenge these defensive real estate and healthcare sectors. So if we're going to get a nice rally today, we really would like to see that coming off of some of these aggressive sectors. Utilities currently is the loser, down almost, well, over 0.75% and moving lower. That is all I have for my portion of the market update. Tom, I'm going to pass it back to you.
All right. Yeah, I just wanted to take a quick look, and then we'll get into our final segment. Just a quick look first. You can see the S&P 500. This is the hourly chart. I'm watching this 2,900 level. This is where we broke down in the short term. coming back up. You can see the earlier high today at 28.97. Currently, we're at 28.91. We need to get back through that 20-hour EMA and through 2,900, which is now short-term price resistance. So that's a level that I would be watching this afternoon. Also, just wanted to mention, if we pull this up, I think if I go and I'm going to pull up the Russell 2000. Notice that the Russell 2000 has not broken below these two lows here. And again, if I go back and show you the S&P 500, we've been sloping down and breaking those lows. So the Russell 2000 does continue to perform better on a relative basis. And I think that is, in general, a pretty good sign. I think if the economy here in the U.S. were to really, if traders were worried, I think that the Russell 2000 at this point would probably be getting hit a little bit harder. And that has not been the case. So just wanted to point that out. And now we are going to go into our final segment of the day, which is Scooter Report. And Erin, what do you have for today?
Okay, well, let us get started. So the StockCharts Technical Rank, that is what we're talking about as far as the scooter. Go take the poll, because it will ask you what the scooter actually is measuring and how we put it together. So go ahead and take that. I am going to start by looking at the technical rankings on my home page for scooters. I really find this to be especially helpful, and I'm going to show you a few ways you can view these top 10s or low 10s. So I'm going to start. Here's where you can find it. Of course, I hope that you all have your DP signal scoreboard up in one of your tiles. But we're going to look at the scooters right now. So here are the top 10, low 10, and we're on the large caps, top up, top down. So there are a couple of things we can do. We know that these are the top 10 performers. We know that they are sitting at the top of with the as far as their peers. So if we want to go look and maybe see if there's something in there that would be interesting to hop on board the train, if these are already on these nice moves to the upside, maybe we'll see some pullbacks. So here are the top 10. Let's see if I can get this a little bigger so we can see everything. All right, so here are the top 10 currently. What I find interesting is you can see momentum is starting to slow on a lot of these leaders that we've had here. But some of these are still on moving to the upside, and we know that they must be strong because they do have these really nice scooter rankings. And just so you do know, the scooter is really weighted towards the intermediate and longer term. Because I'm that kind of an investor, I find it especially helpful to have on my charts. But just keep that in mind when we're looking at these. So right now, just looking at the top 10 here, any of them look interesting? Really, there are two of them. I would say Chipotle looks kind of interesting, and X-Ray looks especially interesting to me. And why is that? Here's our breakaway gap, and it looks like a nice another breakaway gap or even a continuation gap here. We're starting to form a little bit of a symmetrical triangle. That's a continuation pattern, so you should expect the breakout there. PMO on the buy signal, and like I said, we already know that this is a top performer. So X-Ray looking pretty good. I don't even have an upside target here on the daily chart, so let's look at it on a weekly. Look at that PMO, super strong right now. And since we did get down to that -10 level, we could certainly see the PMO get to the +10 level on the upside. Where's the next area of overhead resistance? Well, let me get that annotation tool out and let's take a peek. All righty. I would say we would be going all the way up here to that $65 level for the weekly chart. Definitely a nice move to the upside available. You could also make a little bit of a case here for a reverse head and shoulders on that weekly chart as well. With this breakout, that would suggest a move about the size of that pattern. And boy, that just tends to coincide right here with overhead resistance. So I think X-Ray is looking pretty good. The others look like they're in the middle of a pullback. You know, they're not showing us anything too exciting, at least for me, as far as my indicators are concerned. Chipotle, CMG, looking kind of interesting here. Get this so it's not blurry. Alrighty. But you can see the PMO, while it has flattened, it is starting to move lower right now. We hit that overhead resistance and now we're pulling back. We have gone below that 20-day EMA. It is not held as solid support. So we could end up seeing a move all the way down to the 50 like we saw back here. So, one to keep on the radar maybe, but it looks like it does have some work to do to the downside first. So now let us go right back to where we were on our home page. Remember, we went to scooters. Let's go ahead and look at let's look at some mid caps and what we have there. Let's look at the top ups. There's top down. I know this one was requested for the 10 and 10. So let's go ahead and look at the candle glance and then I'll peek at that particular chart. All right. All right. So looking at these top 10, these are the big movers. And, it doesn't always mean that they're going to have these giant, gap ups when they are the top scooter movers. Again, because this is weighted toward the intermediate and longer term. So sometimes you're going to get that shift, and get that scooter moving, but it doesn't necessarily coincide with, some of the price movements. This one looks interesting to me, but I suspect it is a little on the average daily volume isn't too horrible. Banco Brazil, BDORY. Got the PMO buy signal starting to move up nicely. Volume is pretty steady. I'm not seeing anything bad / good here, but there's that scooter moving it quickly to the upside. Looks like it's heading back toward that hot zone. Here's a trading range here, and it looks like we might have just gotten above it today. And I'll look at that, and then I'll probably look at the RRG, and then that'll be about it. All right, so there, if I line that up with those short-term tops, we do have a little bit of a tiny breakout going on here. May see it close above that trading range. There you go, there's the trading range. Next spot for overhead resistance, all the way up here above $14. So that could be an interesting play if you're okay with a little volatility possibly and a little bit lower volume on the average volume. All right, so we'll go back one more time here. And like I said, there's candle glance down here, but there's also RRG. So we can look at those same stocks that I just had in the candle glance and see what they're doing on the RRG. So I was interested in this one. And it is in the red here, but it does look like it's trying to turn back around. But RRG not looking quite as strong as the chart itself to me. Notice also, all of these are banks. 4 of these are banks as far as the top 10 movers today in the mid caps, which I also find very interesting. Zayo looks like it's the one that's moving to the upside in the way it should. Let's look at that chart. Like I said, I know we did have a request. Big gap up today on strong volume. Not sure what that's about. 50 is above the 200, so that's nice, but that is that big breakout above the short-term tops we see back here. Where's the next level of overhead resistance? It appears it's at $34, I would say, is sort of intermediary resistance. I would say the stronger resistance I would look for here at that top back in September, where it failed to get above the 200-day EMA. But we did see price pop above that 200-day EMA, and the PMO has been rising pretty nicely. So as far as Zayo goes, really nice pop here to the upside. Might need a little bit of a pullback, though, to that $32 range. And that's what I got, Tom. Hopefully I left you a little bit of time here.
Let me go ahead and grab the screen here. I'm going to go through a couple things pretty quickly. First, and I talked about this on the seasonality, I think the medical supplies group's been very strong. And if you look at the market, it's been really weak this week, but look at medical supplies continuing to move higher. This has been a group that's broken out on an absolute basis. I think looks great. On a relative basis, we had been in about a 16-month downtrend channel, and we are just breaking out of that to the upside. You can see the last time, a couple years ago, we had a channel like this. We broke out. You can see what that led to over the next several months. And by the way, April, May, June, July, We're just now getting into May. Let's take a look at that seasonality real quick. Last 7 years, medical supplies has been up every year, May, June, and July. If you look at it relative to the S&P 500 over the last 10 years, in May, it's been up 8 out of 10. And in June, it's been up 8 of the last 9. Of course, we have one more year to go to get that 10th year. Taking a look at a technical scan, what I did was I wanted to take a look at scooters that were over 60, and the rate of change for 20 days, I wanted to be greater than 5%. So I want to get stocks that are starting to show momentum, but aren't already with a scooter up at 95 or, one of the high scooters. When I got this back, I got like 700 and something results, but I just wanted to look at healthcare. And so I went through here and I sorted it by the industry group. And you can see here are the medical supplies companies. You can always come back and take a look at these. But I'm going to go and show you these charts real quick, a couple of them. This one is a Canadian stock on the Toronto Exchange, exe.to. Love this breakout here with increasing volume. Look at the pullback coming back down to the 20-day moving average. This is one to certainly keep an eye on. Erin mentioned X-ray. I think this is a great looking chart here. And I'm going to bring these last couple up here on a relative chart. But X-ray with the big breakout, a couple of different earnings-related gap ups here look great. Align Technology, another one that's been a long-term solid performer in this area, starting to rebuild strength again. I think Align looks good. IDXX, look at the volume coming in here, picking up as we make this move to the upside. A lot of strength beginning to pour into IDXX. HSIC, which is Henry Schein, sideways consolidation breakout. Look at the volume coming in on the gap up yesterday. I'm pretty sure that was earnings related. And the last one I have is HAE, Haemonetics. This had been in a downtrend, but it's starting to look like change of character to me. Love the volume pickup yesterday on that big move. So I think any pullback, especially to a rising 20-day, would look interesting there. Let's go ahead and summarize the charts that we looked at here and our strategies getting there. But you can kind of see from all the scooter reports that we've done on Market Watchers Live, there's so many different ways that you can use scooters to find good stocks and stocks that might interest you. So I thought with the poll, what we would do is just kind of test your sense as to what you believe the scooter is telling you. So the poll today is StockCharts Technical Ranks scores or scooters provide a solid technical analysis evidence regarding, and we wanted to see which ones you went with, relative strength, rate of change, and distance above below key moving averages. Those are the three that were correct.
I'm wondering how many people cheated.
Hey, I don't care.
I picked those, but then I have to admit, I did go back just to make sure.
Well, nobody went with dividend yield. Okay, so that was a good thing. Yeah, the scooter has nothing to do with volume and does not look at price support and resistance. I guess relative strength means that it's probably uptrending and holding support if it's a high scooter rank stock. But there is no formula that looks at the price support and resistance.
Yeah, I mean, I think if you look at those top 10, like I said, sometimes they're not really making those big giant moves or anything. They are actually in a downtrend, but they're scooter moves to the upside.
Yep. And also I want to mention scooters. This is, you're not going to find this anywhere else. It's only on StockCharts. It's an exclusive ranking system developed by John Murphy. And speaking of John Murphy, he's going to be with us here tomorrow. Looking forward to that. And one final time, Erin mentioned it earlier, we are having a spring special right now. Sign up. If you're an existing member, sign up for 12 months. You'll get 2 additional months free. So it is a spring special. Take advantage of that. If you're new, sign up. And if you like what you see, do that annual special and you get those, you'll get your free month plus 12 months plus the 2 additional months for signing up. So anyhow, there you go. There's your upcoming schedule. I want to thank all of you for being with us today. Special thank you to Brian Livingston for joining us today. Please remember to complete the survey as you exit. It's located below the video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.